It's been a week, maybe a month, of hearing all the bad things everywhere you turn. And it's inflation, it's the Fed, and it's Ukraine, it's China, it's supply chain. How bad is it?
Well, the S&P 500, as of right now, is down more or less 20%. And that's the definition of a true correction. And so I would say it's been pretty severe. I think the big question is how much worse can it get? And no one knows the answer to that, and I certainly don't, but it certainly could get worse before it gets better. And, you know, historically, when you see such a profound change in monetary policy, which as we're having now, or in the beginning stages of now, historically it's been, at least over the short term after the change starts, bad for equity values. That's really been the case very often. So it's not surprising that stocks are down now that the Fed has ended this relatively long period of almost free money and is headed up on a substantial upward trajectory in terms of tightening. It's not surprising stocks are down, but I think, as you just said, it coincides with a lot of other negative news, most basically inflation, but also some of the other points you make about Ukraine and so forth. And so it could get worse. Do I think we're on the verge of a financial crisis? I don't. I just think it's a sharp correction in equity values, which, when you step back and think about them, in so many cases, especially tech, were hard to rationalize before this change. I mean, there was some astronomical values, as you well know, and it's not surprising that they're finally being rectified.
So you talk about the equity markets, we can talk about the bond markets as well, which have really taken it on the chin. What is the relationship between those financial markets on one hand and, if I can put it this way, the real world? Because a lot of your work at Evercore is dealing with real companies who are buying and selling companies or pieces of companies. Does it directly translate into the value of those assets, or is it somewhat removed?
It does directly translate in two ways. The stock market is a pretty reliable predictor of the broad economy, albeit 9 months or so in advance of the real economy's changing. So right now there's a big debate as to whether we may have a recession in 2023, and I think that's about 50-50 myself, but we're slowing down even right now, and the market is in effect telling us that. In terms of our own business, oh yes, it has a big effect, because when the volatility is so high, and the VIX this morning was 32.5, I think, before the day started, people hesitate. They want to step back and wait for the smoke to clear and the environment to settle. And so transactions slow down. There's no doubt about it. And you can see that, by the way, in the valuations of all the investment banks, which have come down a lot for a variety of reasons, but one of them is an anticipated slowdown in transaction volume.
But it's interesting, people start to sit on their hands, if I can put it that way. They're afraid to make a move, and that trumps what otherwise might be an instinct. You know, there are some bargains now. So prices are coming down. Yes. It's the price tag is lower. It might cause some CEOs to say, now's the time to move.
Well, and in fact, just on my way over here, I was on the phone with some of my colleagues, because we're having a call tonight with a very, very well-known company that we work with closely. That's a technology company, a very big one. And a lot of the smaller companies they've been interested in buying in recent years have just been too expensive. These aren't tiny companies, but they're smaller than this guy. And we were just observing to ourselves that the valuations have changed so much in the past few weeks that some of these companies they've long studied are now possibly at a level they could buy. So you're right. This environment does create opportunities, but people tend to want to see the smoke to clear or stability to return before they act.
Does it also change the nature of some companies people would be interested in acquiring? In this sense, you referred to the tech sector before. A lot of people say what's going on in tech is basically people have been betting on the come, as it were. It's future earnings. And now they're not as sure, and also as the discount rate goes up, they're not worth quite as much. Does it make more of a premium on companies that are more sort of steady as you go, throw off real cash year in, year out? Does the temperament change?
I think the answer is yes. And to give you a little metric, maybe to support that, in so many areas of technology, the relevant multiple over the last 3 or 4 years has been the multiple of revenue. And so many companies trading at very, very high multiples of revenue. I met with a company this morning which is private, but its main comparable is public, and the comparable had been trading at, I think, 12 or 14 times revenue until very recently. Those are pretty crazy multiples. Yes, there are examples of transformational technology where occasionally something like that is justified, but that was pretty widespread. And it's changing now, and there was a piece in the New York Times this morning about how unicorns have come down to earth, and there are so many of that, so many cases of that. But the answer is yes.
You said that the stock market is a pretty reliable indicator of potential slowdown in the economy overall.
Or the other way around, when the market begins to rise before the economy does. It can go either way. Right now, the market is projecting a slowdown, but we've also seen plenty of examples where the economy is in bad shape, the market goes up, and the market is telling you that 9 months or 12 months from now, the economy is going to be better.
And the Federal Reserve might well applaud something of a slowdown. I mean, they've got to get inflation under control. They've said that's their priority.
I mean, they're seeking it, and they're trying to avoid the so-called hard landing, which is a recession. But they're certainly seeking a slowdown in the economy because most recent inflation number, 8.5%, that's pretty high.
And so that leads to the question about the soft versus hard landing. Slowdown's one thing, recession's another. As you look out, what are your expectations about a possible recession? Or maybe as important, as you talk to CEOs, you talk to companies, do they have that possibly in mind as they think about possible acquisitions or not?
Well, first of all, very few that I would be talking to are yet experiencing a serious slowdown in their own businesses. This is all a question of where will we be in 6 months or so, or later. And I think the big debate in the market is mostly about 2023. Will we see a recession next year? What would cause a recession? It'd be a combination of consumers pulling back, because right now, every single American worker, including you and me, are seeing our real incomes fall because inflation is running well above the rate of increase in wages, although the rate of increase in wages by historical standards is pretty good. It's running at about 5%, but inflation is running at 8 to 9%. So every single American worker is going backwards right this minute. You do that long enough, a few months, for example, and people start to get conservative, and they start to pull back. That would be one factor. And a second factor would be just the impact of higher interest rates. So mortgage rates, as you know, are up about 250 basis points from their level of 4 or 5 months ago. That's a lot. And that's going to impact the mortgage market and the housing markets. I don't think it's enough to bring them to a halt. But we've been seeing a very hot housing market in this country, both starts and secondary sales. And I think that level of increase in mortgage rates, and there's probably more to come on that, is going to slow down that market. So a combination of interest rates, what I'll call consumer psychology as it plays into consumer spending, and maybe business also, just in light of the volatility, pulling back a little bit on investment. Those three factors are what could cause a recession.
Finally, Roger, you've been a leader not just on Wall Street, but also in Washington. Is there anything that President Biden can do about this at this point?
Well, you notice that the last couple of days, really, he's changed his tone on this issue. 2 days ago, he said, this is now my top domestic priority, which is a change of tone. And then yesterday I noticed on his trip, he was standing in front of a big background which said, prices down, inflation control. So they've changed their priorities, or at least the way they state them. Actually, I think that's quite good, and it's not trivial, because you want the American public to think that you wake up in the morning with inflation on your mind and you go to sleep with it on your mind, and every single thing you can do, you're going to do.